The market is down over the last week. We have rising tensions in the Middle East. We have fears among investors that the interest rates may not be cut at all in 2024, as well as a lot of semiconductor companies down due to the fact that we have earnings released over the next few weeks. So investors are worried about the anticipation of how they will report. In today's episode, we want to specifically look at the financial credit services industry and look at MasterCard in particular. We want to do a deep dive. It is down around 2.15%, and we believe that MasterCard is the perfect stock that you need for any high quality portfolio, and we're going to discuss why we believe that in today's episode. As always, with our deep dives, we're going to look at the historical performance of companies. We do want to point out straight away, though, it does have a strong buy according to Wall Street, a buy according seeking alpha analysts, and one hold rating. We're going to do the usual, looking at the company, their top line revenue growth, their bottom line net income. We'll also look at the health of this company, their total cash versus their total debt. And we're interested to see not just what insiders are doing, but also the institutions in terms of the more recent periods. And as always, we'll look at their dividend safety, but go into detail about their free cash flow metrics, their sales, and pinpoint specifically why this is a high quality company. And what we'd like to do is just pull out a few key points from their latest earnings report that they did have at the end of January, as well as forward guidance. As always, though, we are going to run it through the valuation model so you can see our intrinsic value, what our acceptable buy price is given our investor margin of safety, and look towards Wall Street for their forecast over the next 12 months. Now, as we mentioned at the beginning of the episode, this company is down around 2% over the last week, but over the last month, it is down 5.24%, so it could leave some nice room for some undervaluation. But let's take a look in today's episode. Over the last 12 months, however, they are up 22%, and over the last 10 years, bearing in mind this doesn't include dividends reinvested, they are up 543%. We do note they are trading towards the upper end of the 52-week range, with a forward PE just under 32, a forward-looking yield of 0.58% as well. Now, in terms of looking at their all-time highs, we can see not too long ago, in fact, within their 52-week range, it did hit $490. So in terms of the company, we want to look at how they're progressing, why it is a high-quality company. And what we expect from these companies is some strong revenue growth on the top line. Over the last 10 years, they have increased from 9.4 billion to 25.1. So nice to know, a lot more growth than we would like to see on typical, more mature, steady companies of 3 to 7%. And over the longer term, any company you invest in, you do want to see increasing numbers to their revenue. In the more recent year, we can see their top line did increase by 10%. Alongside their top line increase, we also want to see bottom line growth, and we clearly see that nearly 4 times increase from 3.6 billion in FY14 to their more recent annual accounts of 11.2 billion. Again, the bottom line does follow a very similar trajectory than what we saw at the top line. When we take a look at the health of this company, what we typically do with each deep dive, a quick cash short-term investments versus essentially their total debt. What we note, it has gone from around 6.4 billion in December 2014 to around 9.2 billion. So we can see their cash, although very inconsistent, has increased over the longer term. And when we compare it to their total debt numerically and directionally, what we can see, it has increased from around 1.5 billion to around 16.5. So cash has increased, although pretty inconsistently, whilst we see over the longer term, their total debt has increased. Now, it's not a red flag indicator, but it is something we can take a look at when we look at our debt metrics in our analysis. Now, a few metrics that we want to pinpoint. One, the growth grade that they get. They got a B+ metric rating. The reason for this, well, their revenue growth year on year, 13%, above the sector median of those in a similar industry at 5%. We see the EBIT growth at 15.22%, slightly higher than the sector median, but we would like to see a little bit more, hence why they got the C+ rating. And when we do come down and take a look at their earnings per share, now this is the average year on year, 3 to 5 years compounded annual growth rate. Very nice to note, 17.1% year on year, and we have here the sector median coming in at just under 10%. Overall, some very nice metrics, although there are some that we would like to see a little bit better. They get that stamp of B+ on the growth. Now, when we do take a look at profitability, very, very strong. We get a gross profit margin of 100%, sector median at 60%, bottom line margin as well, very fascinating to see, 44.61, significantly higher than that of the sector median. So overall, you can take a quick pause of the video to look at some of these metrics, but on a growth and profitability rating, it does look very positive. Now, what we always like to do with these companies is just have a quick look at how they've performed versus others in the sector. We have Visa, a competitor which we did in fact review not too long ago, and we have Pfizer, PayPal, Aiden as well. We've reviewed the majorities on the channel, so do check them out if you're interested. Over the last year, now this does include those dividends reinvested, you would be up 23%. We can see the second best performing out of the competitors, with FI slightly higher at 26.94. Now, when we extend this to the last 5 years, we in fact see MasterCard again in that second place, second now to Aiden, which was up 134%. And when we look over the last 10 years, we see it the best performing versus its competitors, up 585. So over the longer term, they have performed very well, but remember, past performance isn't an indicator of future performance. And interestingly, if you were aware, every single year that we did take a look, they did also outperform Visa. So historically, they are a better bet than Visa. Now, what I also wanted to do in today's episode, I thought would be quite interesting, something that I did pinpoint when I was doing the research. But typically, when you compare stocks against the S&P 500, the majority of them don't tend to outperform. So you could argue, what's the point in buying companies individually than just buying the S&P? Well, I'm here to answer that question with MasterCard. Year to date, now this is total return, so it does include dividends reinvested. S&P up 4%. We have MasterCard up 7%. Now, when we extend it to the last 12 months, well, MasterCard clearly outperforms 22.87 versus the S&P. When we look even over the last 5 years, MasterCard outperforming the S&P 500. Over the last 5 years, again, 92.6 versus 70.81. Over the last 10 years, significant outperformance. Now, what I'm trying to pinpoint here is that it doesn't always mean you need to invest in the S&P 500. Obviously, different investors will have different strategies. For a lot of investors, they just want to put money in the S&P 500 and forget about it, automate it, and that is nothing wrong with that indeed. But for those that do like to buy stocks, they want to essentially outperform the S&P, that is their goal, MasterCard is definitely one to have on your radar. As we can clearly see over every single time horizon over the last 10 years, it has outperformed. One caveat that we do want to say, we always mention it, but very, very important to understand, just because historically they have outperformed the S&P 500, it doesn't mean that if we do this video in 10 years from now, we will see the same result. But as always, we do like to add this into our analysis. Now, in terms of insider ownership, we have 0.13%, and we can see over the last 12 months, 10 different insiders selling up to 647 million. And in fact, every single quarter over the more recent period, we do note some insider selling. Now, so that we can see who these insiders are, we have a major shareholder who did in fact sell in April as well as March. We also have the CEO as well as the CMO all in 2024, and we can see quite a significant number of insider sales. Now, we want to be transparent, so we show both sells and buys. We personally consider that insider selling isn't a bearish signal. Insiders, we don't know why they sell. It could be personal or financial. But what we do know is that buying is typically a bullish signal, because insiders, they have the information. They know and believe that the share price will go up, hence why they do buy it. But right now, for MasterCard, we can only see insider selling over the last few months. Now, in terms of institutional ownership, pretty high, 97.3%. We note a fair amount of sales, but significant more amount of buys over the period for MasterCard. And in the more recent quarter, Q1 of FY24, we see nearly double, or in fact, roughly around double buys than they did sell. So interesting to note that not just over the last 12 months, but also over the more recent quarter, institutions have been buying more shares of MasterCard than they have been selling. But please understand, never copy what insiders do or institutions. Always do your own investment thesis for each company and always do your own due diligence. Now, before we take a look at the metrics and the dividend safety, we can have a very quick look at their latest investor presentation. Few things that we wanted to point out when we compare their latest results of Q4 FY23 versus the same quarter in FY22. They did, as we can see, beat by double digits every single metric, which is very, very positive. On top of that, what I quite like to see is also improvement on the margin. So not only including or increasing their top line revenue, but also increasing their margins. And we can see also strong increases to their bottom line net income, double digits, as well as we can clearly see their earnings per share. So very positive to note. And when we look at their forward guidance, net revenue for the full year of FY24, they are expecting the higher end of low double digit increases to their revenue. So will be interesting to see because they will be due to report very soon. But for the full year, they are expecting some very strong growth as well. So it isn't one that they are expecting to slow down. Now, we also want to let you know that we have released our latest free weekly article. If you want to know which websites we get all of our resources from, we explain that all completely free, as well as other articles. We have some with massive upside on stocks, undervalued dividend stocks, and just general finance articles. Completely free. Click on the pinned comment below and you can start reading straight away. Now, let's get into the metrics. Dividend safety score 99. It is very safe. In fact, the highest score obtainable. Market cap 425 billion, a mega cap company. Now, for those that believe a recession is inbound and let's wait for a recession to buy some great stocks, well, last recession, how did they do? They maintained the dividend. They didn't increase it, but they also didn't cut it. They had plus 2% sales, well above the average of the S&P, which was negative 12, and they significantly outperformed the S&P 500, negative 12%, with the S&P negative 55, one of the best recession returns from companies we have reviewed on this channel. Dividend growth, what more do you want? Last December, double-digit growth to the dividend. Last 5 years at double digits. Last 10 years at double digits as well. So this is a very, very strong dividend growth company. And we can see they have been increasing those dividends for the last 12 years, whilst paying a dividend for the last 17 without a reduction. Now, in terms of dividend yield theory, for those that are new or regular viewers, just as a reminder, it states that the company is undervalued when the current yield sits above the 5-year average. Right now, we have a sign of reasonable valuation / maybe slight undervaluation with the yield slightly higher. We also note the forward P is also slightly lower than the 5-year of 33.3. And when we compare it, the financial sector P is much lower at 11.1. Now, what we quite like to look at is the free cash flow payout. This essentially shows us how much of the free cash flow is paid out as dividends. We want to see below 60% as a blanket rule. The reason for this, like MasterCard, it gives us faith that management are able to offer those double-digit dividend increases that we love to see. Earnings data, always available. You can always see it when we do review, but it is susceptible to manipulation by management through accounting, so we draw your attention here. Very nice to note that, in fact, it has been around that 20% consistently over the last 10 years. Expected to be that again in the full year of 2024. Hence why we would be shocked if we don't see another strong double-digit dividend increase to those metrics. Now, free cash flow per share, what we want to see in any company, especially a high-quality company, is increases to free cash flow year on year. For the majority of the last 10 years, that is exactly what MasterCard have done. They are expecting this to go even higher into FY24, so we can see no slowing down to their free cash flow. Sales growth, again, nearly every single year. Whilst we want to see a minimum 3 to 7%, they are bringing a 10% increase to their top line. Now, we can argue FY20, due to COVID, the pandemic, it is reasonable for this negative 9% drop. So other than that, and 2015, they have had some very strong years of top line growth. Numerically speaking, as we ran through earlier, we can see they did increase it very nicely, nearly 3 times over the last 10 years. On top of that, they also return that excess cash to investor pockets by doing those share buybacks, as we can see, reducing it from 1.17 billion to 946 in the more recent period. Now, ROIC, this shows us that management are able to effectively allocate their capital. Minimum 8%, as we can see. What we really want to see here is some very strong year-on-year numbers, and that is exactly what we get from MasterCard. 61% in FY23. It isn't a one-off case. As we can clearly see, on average, they are hitting around that 50 to 60% level. So very, very impressive, and makes it a very attractive company for investors. Operating margin, free cash flow margin, just look at how high they are, how much above they are those minimums that we see on both metrics. And in fact, it has increased over the longer term. So that is some small operational efficiencies. As we look to their forward guidance, they are expecting the margins as well as their top line revenue to increase. And free cash flow as well, Do note how important the consistencies are as well in these metrics. It isn't just one-offs that we see. Now, the net debt to EBITDA is very important, the earnings before interest, tax, depreciation, amortization, as it shows us the company's balance sheet strength, which looks phenomenal, as well as their dividend safety, because effectively these are the number of years that it would take the company to pay off all of their debt net of cash on hand. 0.42 expected in FY24, 0.47 was what they reported in FY23. So no worries whatsoever. This is a very strong company with a lot of strong metrics that we ran through. And as we can see here, overall balance sheet looks great, as well as that dividend safety. Now let's jump into the valuation. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's take a look at the first valuation for today's episode. We have the dividend discount model. We have the growth rate year on year. As we can see, average growth rate just under 15%. Forward looking, we've gone 7.5%. This gives an intrinsic value with a massive undervaluation signal, 567 versus 455. Now, when we take a look at the next model, we have the discounted cash flow model with free cash flow growth over the last 10 years. On average, just under 16%. So forward looking, we have gone essentially more conservative than analyst estimates, as well as the average at 14%. In conjunction with the discount rate at 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, another undervaluation signal. So typically what we do is we get here and we take the average of the models that we've used. For today's episode, it does amount to $530. And do remember, you can click on the pinned comment below so you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio. Now what we typically do, we start off with a 10% margin of safety. We execute on that if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that with MasterCard today, it does look to be a buy up to $477. And then we keep going till it's near the current trading price. 15%, it isn't quite there yet, as we can see, around $450, but it's not too far off that. So for today's episode, we do see around a 10 to 15% MOS level for ticker symbol MA. How about Wall Street? Well, in the beginning of the episode, we did say it was a very strong buy signal, and we can see they do estimate around a price target of $518 over the next 12 months with upside of 14%. So not only do they see it as a strong buy, there is nice upside, and as we ran through, there are a lot of very strong metrics. In fact, every single metric we ran through does look very strong, not just in the year, but also consistently over the longer term. As always though, do let us know your thoughts in the comments below. For me, this is a very high quality company that if you are looking to outperform the S&P 500, this would be something that has to make at least your top 5. But as always, do let me know, as we did compare historically versus the S&P 500, MasterCard has outperformed it year to date over the last year, last 3, 5 and 10 years as well. As always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button, let us know your thoughts, and as always, we'll see you all on the next one.